Okay, so today we are diving into a formula that's been misunderstood and misused, even worshipped blindly, especially by retail traders or investors, including amateur quants. And somewhere along the way, the purpose of this ratio has been distorted and it's kind of become a false badge of strategy superiority. And I have done my best. I've debated with people over emails in comment section, but surprisingly difficult to convince them because they've already made up their minds without truly doing any research. And all they're doing is just create the strategy and check this formula, and that's it, go for it. And that's like the biggest pitfall. And this is ruining many traders and investors out there, and this has to stop. And if it's not stopped, it can create big losses, and it's continuing. The losses are accumulating for many of these retail traders and investors out there. So that equation essentially is the Sharpe ratio. So we'll just do a rough definition on what Sharpe ratio is. So basically it is just RP minus RF by sigma P. So RP is a portfolio return. RF is a risk-free rate, which is the rate offered by the banks for the Federal Reserve, and sigma is the standard deviation of the portfolio. So for amateurs or ignorant quants, essentially, and newbie retail quants as well, the popular opinion around them is that higher the better. And if the Sharpe ratio is greater than 1, it's good. And if it's greater than 2, it is elite. Even though most of the famous investors, including the best investor in the world, has got a Sharpe ratio below 1. So let's go deeper into why the situation is, and we'll do an example calculations, multiple example calculations to get an idea on why this Sharpe ratio number, this formula kind of fails all these investors. So the first problem is that it punishes positive volatility. So it treats all volatility as bad. So, there are strategies which got like a good performance. For example, it's got like plus 20%. And then sometimes there's a strategy of minus 20% on a monthly return. So Sharpe ratio is not good in identifying that. So they'll be like, hey, plus 20% is as bad as minus 20%. So if it's negative, it's totally understandable. But if good performance is treated as bad, that's not a good quality you could have in a formula. So let's take two examples here. So I've actually made a table, and basically it's month 1, 2, 3, 4. So you can actually imagine as an year as well. And then there's strategy A and strategy B. So strategy A, you've got all these returns per month, and then strategy B is the performance monthly here. So let's do the calculation. So mean is pretty much basic. It's just add these four numbers and divide by 4, which is 4.25. And now we'll calculate the variance and the standard deviation. So basically the variance would be 10 minus 4.25, the square, and then 0 minus 4.25, the square, and then plus 9 minus 4.25, the square. And we add all those numbers up, and then we got the sum, and we divide it by 4, and that's the variance, and then we square root of that, and that gives us the standard deviation. So standard deviation here is 5.31. And the Sharpe ratio is the RP, which is 4.25, minus risk-free rate. So for this example, I'm just going to ignore risk-free rate because it's the same for both sides of the equation, for both strategy A and strategy B. And to make the calculation quite simple, so we'll just do 4.25 divided by the standard deviation, and we get 0.80. So that's the Sharpe ratio of strategy A. Similarly, we can do that of strategy B. Same thing, we just add all these numbers, divide by 4, we got the mean, and then plus 2 minus the mean, the square, 0.25, and we add it all up and we square root it, and that gives us a standard deviation. So we divide the RP minus RF divided by the standard deviation gives us 3. Now, look at the Sharpe ratio of strategy A and strategy B. Strategy A has got 0.80 and strategy B has got 3. So theoretically, people would say that, hey, Sharpe ratio is better for strategy B, and henceforth we have to choose strategy B. But let's take a look at the performance here. The strategy A has got plus 10%, plus 9%, and just got 1 month which is minus 2%, as compared to strategy B, which is just mediocre strategy. It's just plus 2, plus 1, plus 2, plus 1. It's nothing significant. So you can see how it has punished the positive volatility in the plus 10 and plus 9. So in this comparison strategy, even though a Sharpe ratio for this one is higher, it's not technically the superior strategy. So you can already see now one of the biggest pitfalls of Sharpe ratio is that punishing positive volatility. Now, Let's go on to the second problem, and that's fat tail. So strategy sometimes can have massive loss and massive gains, or sometimes can have small losses, small gains. It depends on the strategy. For example, mean reverting versus trend following strategy. Let's take an example here. So I'm going to go into the strategy which we have in our course, which is a mean reverting strategy here. And in the trade analysis, if you go, because it's a mean reverting strategy, you can see the average winning trade and average losing trade to be kind of close by, which is very common in the mean reverting strategy. So now let's take the case of Apple, and let's do another strategy here. Let's do this one here, and we will. And for this one, which is an Apple, you can see the average winning trade is 40% and average losing trade is 10%. Now, if I can go back into this situation here, so you can see complete separation between the mean reverting and trend following strategy. So let's compare this in this example here, the month 1, 2, 3, 4. I've got strategy A, strategy B, and strategy C. And strategy A, you've got the plus 1%, plus 1%, plus 1%, and minus 10%. And then you've got strategy B, 1, 1, 1, and minus 0.5. So when you're comparing strategy A and strategy B, it's okay. The Sharpe ratio is good in calculating it, because in strategy A, we've got a negative Sharpe ratio, so there's no need to go for it. And then minus 10% is significant, so we can stop trading strategy A, or we should not be using strategy A. And strategy B is definitely better. 1.35 is superior to minus 0.31, and the results kind of show the strategy B is better. So now let's compare strategy B and strategy C. So here we've got plus 1, 1, 1, and then we've got plus 10. And even though net this has performed much superior than strategy B, even without a single month of negative loss, the Sharpe ratio is 0.83. It's inferior to that of strategy B. Even though it has got not even a single month negative loss, it's got much better performance, and still it shows that the Sharpe ratio here is worse than that of strategy B. So this is what I'm talking about, mean reverting versus trend following strategy. So here you can see the strategy B is kind of because it's the negative and positive is kind of close as compared to trend following strategy, which is like 10%, which is expected, for trend following strategy or momentum trading strategy. Or most of the people investing, they tend to have certain strategies, certain times where you get big results, and then certain times where you get like small negative losses. So in strategy C, we've got 0.83, which is inferior to strategy B. So this Sharpe ratio comparison definitely becomes a problem here, and that's the problem. The fat tails, it doesn't adjust for fat tails when it comes to strategies, and that's again another pitfall of Sharpe ratio. So this whole problem when it comes to fat tails, or whether it comes to punishing positive volatility, all comes down because of one major problem, and that's the averaging problem. So as we discussed before with the calculation of the mean and standard variation, Sharpe uses the average return and average volatility. So it ignores the order of returns, i.e. the path depends. So certain strategies, it makes a big loss early on, and then you have to work harder to make up for the losses, as compared to a loss which is much later on and things like that. So Sharpe ratio is not really good in predicting those things. So it ignores the order of returns, and if a strategy has kind of got a wild swing but it ends very high, the mean kind of return looks good, and then if the swings are symmetric, then the standard deviation will be low and the Sharpe ratio will be high, despite you've got high drawdown or ruin risk. So let's take the example here, for example, strategy A and strategy B, and look at strategy A. We've got minus 70%, 140, minus 70, and 140, right? So imagine your $100,000 fund to go from $100,000 to $30,000. That's 70% drawdown. That's bad. Most people would quit. Most people would just say, you know what, I've just lost $70,000 of my $100,000 fund. I don't want to trade anymore. Now, this Sharpe ratio will be exactly the same as strategy B, which has got minus 5 plus 10, minus 5 plus 10, which is common for many people out there on a monthly basis. It's expected to have those kind of swings. But both strategy A and strategy B is the same. And you would think, hey, Sharpe ratio should be picking this up. But no, Sharpe ratio hasn't picked them up. Sharpe ratio has completely ignored this whole drawdown thingy, and that essentially is because of the averaging problem. It has fundamentally flawed because of the average return and average volatility and the way the calculation has done. So it's not really good in capturing the wild swings, or if the swings are symmetric or small as well. So that comes as the biggest problem, which is the most biggest problem, and it fails to capture black swan or maximum drawdown. So like I said before, it's purely based on median standard deviation, and Sharpe ratio assumes a normal distribution, and that's a big flaw in it. So when you have real disasters like the dot-com bubble or the 2008 global financial crisis or the wars or anything or some kind of an outliers, these things are not captured by the standard deviation. Maximum drawdown is a peak to trough capital loss, and Sharpe ratio has no memory of that path. They don't store that information on maximum drawdown because it kind of get cancelled out because it's averaging all these numbers together and it's completely ignored that maximum drawdown. So a strategy can have a Sharpe ratio 1.5 or 2 but has a maximum drawdown of 80% or 90%, and imagine that $100,000 of your fund go down to just $10,000 fund. So it fails to capture that. It fails to completely capture the black swan event, and that's a huge issue. So we have debunked many of these things about Sharpe ratio so far. So some of the weird facts about Sharpe ratio is that, for example, if you take long-term capital management, which was run by Nobel Prize winners, quantitative traders, and they had a Sharpe ratio of 2 to 4 and they collapsed. The most famous investor of all time, Warren Buffett, had a Sharpe ratio of 0.79, and if you want to look at those numbers, that's there in this journal, Buffett's Alpha, by these people, and therein they concluded the Sharpe ratio of Warren Buffett to be 0.79. So far in this video, we have actually concluded many things about Sharpe ratio. We have debunked the whole idea of Sharpe ratio greater than 1 to be good. We have debunked that comparison of two strategies with Sharpe ratio is also absolutely rubbish as well, because a Sharpe ratio can have like 2 or 3 and still produce average or below average return, or have a crazy maximum drawdown, or even can get collapsed. So as we have debunked the Sharpe ratio and why it's not a good metric at all, we need to go and find a replacement for Sharpe ratio. So what instead? What is the next best thing that we have had? So the best thing, in my opinion, and among many of the quant traders out there, is the CAGR to maximum drawdown ratio. So let's break it down. So what is CAGR? So CAGR reflects the long-term growth. So it measures geometric mean annualized return. So it reflects the compound growth rate of a portfolio over time. And that's not sensitive to short-term fluctuations like, say, for example, arithmetic averages. And if you have a loss, say, for example, in month 2 or year 2 or year 3 or year 4, it gets reflected in the CAGR. It's not going to run away or something, because overall, when you backtest over 10 years or 20 years of forward test, that big loss will be reflected in the CAGR, and it doesn't get averaged out like Sharpe ratio. So CAGR is a good measure, and we have to compare it with the maximum drawdown, the CAGR to maximum drawdown ratio. So maximum drawdown is observed from a peak to trough during a specific period. So it focuses on the most severe downside risk rather than the average volatility. So you get to have that metric, that worst case scenario, what happened in the financial crisis or what happened in the dot-com bubble, all factored into the maximum drawdown, and you know if your strategy will survive during those events, during the forward test. So can it handle that stress test? So that CAGR to maximum drawdown ratio helps us identify it. So this ratio, CAGR to maximum drawdown ratio, it directly compares return growth to downside risk. So higher ratio indicates that the strategy delivers significant growth relative to its worst historical loss, and it avoids all the normal pitfalls of normality assumptions that we have in the Sharpe ratio, and it also emphasizes capital preservation because we're looking at the worst case scenario as well. And on top of that, it's also good to compare other strategies. So on theory, what we want is, like, we always want to beat the S&P 500 buy and hold. So if your strategy is not beating S&P 500 buy and hold, then there's no point in even having a strategy. You might as well invest in S&P 500 buy and hold. And that's essentially the comparative measure for every single quant fund or a hedge fund or a retail trader or investor or anything. Since inception, S&P 500 has a buy and hold CAGR of 10% and maximum drawdown of 55%. So that ratio is 10 divided by 55, which equals 0.18. So if a strategy has a CAGR to maximum drawdown of greater than 0.18, it's considered good strategy. And that's what we should be aiming for. And the other advantage is, once we know that, we can apply a little bit of leverage to it. So for example, if you have a CAGR of 10% and maximum drawdown of 20%, so that's like 0.5 CAGR to drawdown ratio. So it's 10 divided by 20, so that's 1 by 2, it's 0.5. 0.5 is much superior to 0.18, and we can apply a little bit of leverage to it, because now if I apply 2:1 leverage here, I can get 20% roughly CAGR and a maximum drawdown of 40%, and still it beats the CAGR to drawdown ratio of S&P 500 maximum drawdown, because maximum drawdown here would be 55 and maximum drawdown with leverage would be 40%. Now, you shouldn't use leverage a lot. So even in this article, they said that Buffett's leverage is about 1.7, which is really not that extreme. So in my opinion, it always should be below 2. Anything higher than that, you're actually pushing it a bit. But based on how much reduction you can do with the CAGR to maximum drawdown, you can apply leverage based on your situation. So that's the other advantage of CAGR to maximum drawdown ratio. You can see that if I apply leverage, what's the worst case scenario? What's the worst maximum drawdown I can have? So in this strategy, I can estimate the worst drawdown could be somewhere in that 40%, that area. So if on the other hand, if I had a strategy which is like 8% CAGR with the maximum drawdown at 15%, then it's much higher, right? I can add a little bit more leverage to it because the CAGR to drawdown ratio is much higher than 10 divided by 20. So these are all some of the advantages that we can have by using CAGR to maximum drawdown ratio. So hopefully you've understood why Sharpe ratio is kind of misused and misunderstood among retail traders and amateur quant traders out there, and hopefully you will stop using Sharpe ratio as a measure for performance and also as a comparative measure to compare strategy A and strategy B, but instead use CAGR to maximum drawdown as your fundamental tool in identifying strategies and also comparing strategies and applying strategies in your day-to-day life. Of course, there are many other ratios. We're not going to go deep into, like, for example, the Sortino ratios and all those things, but fundamentally, I would say Sharpe ratio is the most popular ratio that's used, but that's like the worst ratio you could use, and instead it's better off you use CAGR to maximum drawdown ratio. So hope you understood what we are trying to imply in this video. Have a great day. Bye bye.